Let's have a sesh on financial formulas and ratios. So we all know the old formula, profit equals revenue minus costs. But let's look at a little bit more into that formula. So profit equals revenue minus costs. We know that if revenue is greater than costs, clearly it's profit, and if costs are greater than revenue, clearly it's a loss. But when we think about profit, what type of profit do we mean? I mean, there are 4 different types of profit. So which profit really does profit mean in the profit formula? And I suggest that it probably means net profit, because that's the bottom line. That's accounting for all the expenses, the costs the business has. And if we assume that it is net profit, then really the formula is net profit equals sales times price for each product, because your revenue is basically how much you sell it for times by how many you sell. But sometimes businesses sell more than one product, they sell many products, so you need to do that formula for each product, sales times price for each product. And you need to take away total costs, all the expenses. So net profit equals revenue, which is just that, minus fixed costs plus variable costs. Because for total costs, the formula is fixed costs plus variable costs. And fixed costs are costs that do not change with output, such as rent. Meanwhile, variable costs are costs that do change with output. They change with output. Example of that would be raw materials. If you're making t-shirts, you need more cotton or polyester to make those t-shirts. Every t-shirt you make, you need more of it. So net profit equals revenue minus fixed costs plus variable costs, which is effectively your total costs. Important thing to know, net profit margin, because you can calculate this off of this, because your net profit margin is effectively your net profit divided by your revenue. And you need to times that by 100 and you come to a percentage. Let's just say if I put some numbers in, it came to 20%. Well, that 20% is the conversion of your sales into profit, into net profit. And in this case, it means that for every £1 of sales, 20 pence is net profit. If your net profit margin, your NPM, was 20%. Now you can have other margins apart from the net profit margin. You can have an operating profit margin, and all that is just, instead of net profit there divided by revenue, it's operating profit divided by revenue. You can also have a gross profit margin. Again, you just put gross profit at that point rather than net profit, and that gives you another ratio. So you've got net profit margin, gross profit margin, and you've also got operating profit margin. They are the 3 types of profits that you find on the income statement. There is another profit, which is retained profit, that you find in the statement of financial position. But there isn't really a ratio for calculating that. If you go on to be an accountant, there's something special called the retention ratio, which is effectively just taking your net profits, taking away your dividends, and then divided that all by your net profits and timesing that by 100. But you don't need to know that. What you need to know is if you like this video, please subscribe. And wait a minute, where is it? Here it is. Subscribe, click on that button. Thank you.